Okay, guys, this is one fella I always enjoy listening to. It's Alasdair Macleod, and I got an article here he's done. Now, uh, it's you can find the article at Gold Money. It's the deflation inflation debate, and also you can find a link to it at Zero Hedge too, is carrying the article, and it's a very good article. I'm going to read some from it here. But basically, summing up the article, going down here and summing it up at the end, this says the Fed's only response to the next credit crisis will be to take measures that will lead to the final destruction of the dollar. Other central banks are set to follow. Deflationists do not have a leg to stand on, and unknowingly confirmed with von Mises' description of naive inflationists. Now, here's the thing. I personally believe that the deflationists do have a leg to stand on, but it's not going to last very long. I believe there's going to be a very short-lived deflation, and I believe that this is what's going to trigger the inflation. Is the deflation. It's going to cause the central banks to react. Right now, what they're doing is they're withdrawing liquidity from the system. Anyway, I've been over what I think's happening. Now we're going to listen to Alasdair Macleod and what he sees happening in the system right now. And he says, it's hardly surprising that with equity indices stalling, the financial community is increasingly worried that the long, steady bull market is coming to an end. Naturally, this makes investors look for reasons to worry, and it turns out that there are indeed many things to worry about. In fact, there are always things to worry about. Ever since the Lehman crisis, the four horsemen of the apocalypse have been casting long shadows across the financial stage. But as financial assets have come to rise in value over the last 9 years, bearish fund managers, spooked by system risks of one sort or another and the perennial threat of a renewed slump, have been forced to discard their usine views. As often as not, it is not much more than a question of emphasis. There is always good news and bad news. As an investor, you semi-consciously choose what you want to believe. There are causes for concern. Of that, there are no doubt. Mostly they arise from the consequence of earlier state interventions on the money side. Governments are slowly strangling private sector production with increased rapacity, demands on taxpayers, and have been resorting to the printing press to finance the shortfalls. In reality, there is a finite limit to government spending because it impoverishes the tax base. Yet governments, with very few exceptions, seek to conceal this truism by increased spending and budget deficits even more. In this, President Trump is not alone. Bankruptcy is the end result, and I don't believe the old saw about how governments can't go bust. They can, and they do by destroying their currencies. As von Mises implied in the quote above, the naive inflationists referred to by von Mises justify their stance by believing that the inflation is invigorating and deflation is devastating. And by all statistics pointing to a slowdown in growth of money supply or the economy is therefore taken as a forewarning of deflation. Inflationists are simply recycling Irving Fletcher's debt deflation theory, which is no longer relevant. Fletcher held that in an economic crisis, bad debts force banks to liquidate collateral, pushing down collateral values, and as previously loose loans lose their collateral over recover, banks are forced to liquidate those as well. But that is no longer the case. Central banks have removed the discipline of gold so that they can intervene to prevent financial and economic crisis, rather than let them run their destructive courses. They have fully embraced inflationism, giving them the excuse for monetary and credit expansion as a cure-all. Well, you know, it's more than that. Going back, I mean, for the last at least 30 years, they've been expanding credit. And the problem with all this credit is they keep expanding is that the flip side of that credit is debt. So what they're really expanding is debt. And so everything that the banks are all counting as credit is actually debt. This is why Greece was a bomb to the entire system and why they had to keep Greece going. This is a big game they got going with Greece. It's almost laughable. What they're doing is when Greece comes around for a loan payment back to the ECB extends them another loan to make the loan payment with. So basically they say, here, to Greece, and they hand them 10 billion euros. And they say, now pay us that 10 billion euros back as your loan payment. And we're just going to increase the debt $10 billion higher. And why they do that is because if Greece were to say, okay, we're throwing off this burden of this debt, and we are, for real, we're going bankrupt, and you're never going to get it back to the ECB, then the ECB has to make good for that. Right now, the ECB is holding Greece as a credit on their books of the money that Greece owes plus the interest that they're going to pay into the future. So Greece owes, like, I think it's 320 billion or something to that effect. I forget exactly what the numbers was. I was just saying that off the top of my head because that's what I think I remember. It was 300. It's some enormous sum like that, 320 billion euros or something like that. Now, when you consider in the interest, it probably doubles that amount of money to like $600 billion. So as long as Greece continues to say, okay, we're paying those loans back, nobody can come out and say, okay, they won't pay those loans back. So as long as they're making their loan payments, everything's fine with the European Central Bank. They can keep that as a credit. That like $600 billion, which is what Greece owes them back plus all the interest payments, they can keep that as a credit on their books. But if they have to go in and they have to say, hey, you know what, Greece just went bankrupt, then they have to go in and then they have to take that $600 billion off of their books, and it creates that would create an enormous black hole in the books of the European Central Bank. And banks are funny. They're funny creatures. They can create money out of nothing. It's called fractional reserve lending. And how it works is they only have to have a fraction of the reserves and they're allowed to lend money out. In other words, they're allowed to create these loans. And when they create a loan, they're creating money. So when they loaned the money to Greece, they created that money from nothing. And when that money is created from nothing, it becomes a credit on the bank's book. So the bank basically still owns that money that they just lent out and they just created from nothing. But if that money's not paid back, suddenly there's a hole in the bank's book, right? And the bank does not have the money creation tool to fill that hole. So if if Greece didn't pay the ECB back, and they had to create an enormous hole into their book, or an enormous debt, suddenly they would be bankrupt. The European Central Bank would be bankrupt. Because they can't create the money to fill that hole. Their money creation tool doesn't work in that direction. So then, there's only one source then to fill that hole when a big bank gets in trouble, like say Deutsche Bank were to get in trouble. They have to be bailed out, and not a bail-in. Now, an awful lot of people out there, they say, hey, you know what? The banks are going to do these bail-ins. And the banks could do these bail-ins. But at the first hint of the word bail-in, there will be a bank runs, especially in North America. And don't you think the banks don't know that? So this whole thing happened in Italy. Over in Europe, the the Europeans put in a system, I think they call it the BAARD. It was a law that was passed quietly. They passed it quietly. They passed a similar law here in the United States, and they passed a similar law in Canada and England. They passed a similar law over in the United Kingdom. And this law basically says that the banks are ready to do bail-ins. And this is where they steal your money. They actually take your money. They take the money from the creditors to the bank. And so they got this law in place over there in Europe, and they said, okay, when the next bank trouble comes along, we have this law in this BAARD law, and we are going to do bail-ins to the system. This is how we're going to handle this. This is a new policy. So sure enough, Italy got in trouble. Italy was the first test to their new policy. Right? Italy was going to go under I guess about 8 months ago. Italy was going to go under. There wasn't any hope for Italy, except for a bail-in. The banks could not do the bail-in. They couldn't do it. It would have created bank runs. On paper, it looks good. They say, okay, we're going to do bail-ins. On paper, it looks good. But when the bank really goes to do it, the people screech so loud, and the people get so upset, and they all want to they all want to pull their money out of the banking system. And this creates an even bigger black hole for the banks. That in actuality, they can't do the bail-ins. They have to have a bailout. And so what they did was, in Italy, is the Italian government bailed out the banks again. I think it was $20 billion, or 20 billion euros, I should say. And they've been running on that bailout right now. That's what's been keeping the Italian banks up and running. And they went against their own rules and did a bailout. Now, when push comes to shove, and these big American institutions and big American banks get in trouble this time, they're not going to bail in. I know they said they're going to bail in. Everybody's worried about a bail-in, but they're not going to do it. What they're going to do is bailouts. At the last minute, they'll do bailouts. They'll bail out all the big banks. And this time, it's going to take much, much bigger amounts of money. This is what's going to kill the dollar. It's going to cause hyperinflation. So anyway, I guess I got sidetracked a little bit. Minor wobbles that are not in the credit crisis. We must discriminate between the momentary problems faced by central banks and the inevitable crisis at the end of the credit cycle. Dealing with problems as they arise has become routine, the justification for continental inflationism. The credit crisis is a different matter. Central banks do not seem to realize it, but the credit crisis is their own creation. The way markets eventually unwind distortions created by earlier monetary policy, so long as central banks suppress interest rates and expand money and credit, there will be periodical credit crises to follow. The trigger for a credit crisis is always the same. The general price level threatens to rise uncontrollably, reflecting the loss of the currency's purchasing power. This forces the central banks to reluctantly raise interest rates to the point where business assumptions about the return on capital based on borrowing costs turns from profit-making to loss-making. At that point, if not before, the accumulated mountain of debt becomes fatally undermined. The timing of the rise and level of interest rates that triggers the crisis is set by the speed with which monetary inflation feeds into prices, and the severity of the crisis depends upon the size of the debt mountain being liquidated. This has nothing to do with the minor wobbles along the way and ahead of a cyclical credit crisis. Central banks routinely deal with the fires breaking out in an increasingly desolate economic landscape. They are very good at it. The share of prices of the European banks, such as Deutsche Bank and Credit Suisse, raise concerns over systematic risk, but the ECB and the SNB will always ensure credit is available to them. And if we are worried about systematic risk to the key European financial behemoths, Why is that stock prices for major U.S. banks such as J.B. Morgan, Goldman Sachs, and Bank of America so strong? Well, this is the thing. Yeah. That's why stock prices in Deutsche Bank fell very low there a week or two ago, and now they're bouncing back a little bit. And the only reason they're bouncing back instead of the bank actually crashing is that the ECB, it says, will always ensure credit is available to the big banks, and the SNB and also the American banks are covered by the Federal Reserve. And when they get in trouble, this is what's going to happen. They're going to bail them out. This is basically what he's saying right here. Says how bank credit is used and is rarely questioned. With charts of money supply do not tell us where the money is deployed between two groups of borrowers. Newly created money, mainly bank credit, is allocated either into the financial sector, which is not included in GDP except fees and commissions, or into the non-financial activities where goods and services are included. Furthermore, missing from GDP is all the intermediate business-to-business activity that goes toward manufacturing and delivering the goods and service included in GDP. And it is B2B, which borrowers to invest. It is only when extra money is allocated through the markets to the production of items and the consumer price index that the price inflation is recorded. However, we cannot know how new money is allocated and reallocated between the arbitrary divisions set by statisticians. Attempts to marry up changes in broad money with demand for it are never convincing. But proxy for non-financial business activity away from the world's big corporations, the following chart appears to confirm that ordinary businesses are just getting on with commercial life and have been for the last 6 years, although you wouldn't know it from financial headlines. I'm going to skip down here to the end a little bit. He goes on to talk about the credit cycle, and it gets pretty long here. That's why I'm going to skip down to the end. I'm going to read the final conclusion one more time before I end my show. He says the Fed's only response to the next credit crisis will be to take measures that will lead to the final destruction of the dollar. Other central banks are set to follow. Deflationists don't have a leg to stand on. And I happen to agree with that. But I believe what's happening is right now they're acting in a manner that's not normal to the central banks. Their normal manner is to increase the money supply, to create money and everything. What they did was after 2008, they came in with so much stimulus that now they're trying to get a toehold before the next financial crisis so that they can have something to work with. They realize at this point that they've created a problem for themselves. They've boxed themselves in. And so what they're trying to do is they're trying to reverse, but it's a little bit too late. They're the old saying, they're a day late and they're a dollar short. And this reversing that they're doing, which is a total reverse of what they had been doing, this tightening, quantitative tightening, is going to lead to a system collapse. And then, in order to get things going again after the system collapse, they're going to have to come in with stimulus like you've never seen before. And they don't have any other choice. And this is going to lead to the ultimate conclusion of this whole scenario. I'll tell you honestly, I am absolutely amazed that the dollar is staying as weak as it's staying, considering what they're doing right now. Considering what they're doing. I'm amazed that the dollar's staying as weak as it's staying. And one of the only things that's really weak, that's holding the dollar down right now, is oil prices. It's the whole thing is getting ready to begin. And it's not going to be pretty. I hope you guys are ready for it. Listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next show.